Okay, well, good morning, everybody. Thank you, everybody who is braved coming into the IFS basement to see this in person. Thank you to everybody who's watching on YouTube and those who are watching on Zoom. We are going to do this as we normally do. I will start with some opening remarks about yesterday's spring statement, and then three of my colleagues will go through specific aspects of it. Carl Emerson will talk about the public finances, Ben Zaranko will talk briefly about public service spending, and then Rob Joyce will talk about living standards and the impact of changes of tax and benefit changes on people's incomes. Those of you who are watching on YouTube can ask questions by Slido in the room. Obviously raise your hand, and similarly on Zoom. We've heard a lot about the specifics of yesterday, and everybody, of course, is focused on the current crisis, the cost of living crisis. But I think it's a little too easy in responding to yesterday to forget that the very recent past, you remember COVID and the huge work that the government did at that time. The £70 billion furlough scheme ended less than 6 months ago. It seems extraordinary now, doesn't it? The economy is still in recovery mode. That was the biggest economic shock in a century. It sent government debt and borrowing spiralling to record levels and involved greater government intervention in the economy than any moment in peacetime. And if we don't remember COVID, what about Brexit? The OBR still sees no reason to revise its view. It will have a substantial downward long-term negative effect on national income. Then there's the ever-lengthening shadow of the financial crisis more than a decade ago. But it resulted in a decade or more of stagnant incomes and flatlining productivity. And all that history matters in assessing the severity of the current problems and the Chancellor's response to them. COVID left the deficit, and especially the national debt, higher. Public service spending was squeezed tight after 2010, and the working age benefit system made much less generous. Brexit has slowed growth on top of the post-financial crisis slowdown. Household incomes today are far lower than they would have been in the absence of these shocks. On some measures, average earnings could have been as much as £11,000 a year higher had pre-financial crisis trends continued. So neither the nation's finances nor household finances were in great shape when the latest economic shock, the worldwide rise in commodity prices, hit. The expected sharp fall in real household incomes this year is all the more difficult, and all the more shocking coming off the back of such a long period of feeble growth. And a Chancellor looking both to balance the current budget and provide at least a little succour to public services after the austerity years really did have very little room for manoeuvre. On the public finances, Mr Sunak has proved to be something of a fiscal illusionist. He told us that he cut taxes yesterday, and he did. He increased the floor for national insurance contributions and promised a cut in income tax in 2024. So Mr Sunak's statement contained big new tax cuts. But it also allowed taxes to rise. He can now expect to raise more in tax as a share of national income by 2025 than he expected in October. In fact, taxes are set to rise to their highest level as a fraction of national income since Clement Attlee was Prime Minister. Not my comparison, that comes directly from the OBR. On current plans, Mr Sunak's income tax changes won't actually depress income tax revenues in 2024-25. Despite the cut in the basic rate planned for that year, the income tax take will stay about the same as in the previous year and then continue rising. That's the effect of inflation and fiscal drag. They've magically doubled the scale of the tax rise he announced last year, the 4-year freeze in the personal allowance and higher rate tax threshold. The proposed cut in the basic rate gives back only about half of the additional windfall he's now expecting to enjoy from that measure. There's another illusion in there too, the annually repeated illusion that fuel duties will actually rise next year. Not only do the public finance forecast depend on the 5p cut being reversed, they assume an increase in line with the RPI on top of that. The odds against the former feel long. I reckon an RPI increase on top is about as likely as my winning the national lottery, and I don't play the lottery. Given all that, by the end of the forecast period, the Chancellor supposedly has a little more wriggle room against his fiscal targets than he expected in October, despite lower expected growth and those tax cuts. That's because not only is he allowing taxes to rise, he's not actually cutting them, he's also effectively cutting spending on public services in real terms relative to previous plans. Yesterday, he offered them no extra cash at all to deal with higher inflation. The exact scale of this cut relative to previous plans is a little uncertain, but it is significant. It will almost certainly mean some hefty real pay cuts across the public sector, coming on top of cuts both in real terms and relative to the private sector over the last 12 years. The immediate aim of the statement, of course, was to help relieve the current squeeze on the cost of living. And let's remember, what was announced yesterday does come on top of February's £9 billion giveaway via council tax rebates for 80% of households and the repayable rebate on energy bills. But of course, it also comes on top of the national insurance increase announced in October and the freezing of the income tax personal allowance and thresholds announced a year ago. But all of those together and the net effect of the measures is actually a relatively modest giveaway to households of in the order of £5 billion or so in 2022-23. Against the baseline of normal uprating, it's a pretty progressive giveaway, in fact. People in the top 10% or so of the income distribution lose quite heavily, and as a fraction of income, gains from the measures are highest at the bottom and gradually fall with income. The council tax and energy bill rebates play an important role here. And overall, that is a definition of a progressive set of measures. Those of us who have criticised the Chancellor for failing to do more for benefit recipients should at least acknowledge that. The problem is that this will still not be enough to protect poorer households in particular from a significant hit to their living standards. The failure to do more than default indexation of benefits will leave many of those who struggle most worse off. In the long run, this year's giveaway turns into a substantial takeaway. The overall impact of the reforms remains progressive, but the council tax and energy bill rebates disappear, leaving only very small gains at the bottom, largely arising from the cut in the universal credit taper announced in October. The national insurance floor, having been increased sharply this July, is frozen through to 2026. The impact of freezing income tax allowances and threshold grows, taking an increasing amount from higher earners. Cutting the basic rate of income tax is regressive, but, as we've seen, not as big a change as those freezes. The big increase in national insurance contributions remains a big hit on higher earners, who are still the big losers. Perhaps surprisingly, this actually continues a trend since 2010. The highest earners have been, by a distance, the biggest losers from tax changes implemented since then, though remember, of course, the benefit recipients have lost even more as a fraction of their income. In the short term, one problem is that this combination of tax cuts and rebates just isn't enough to offset the fall in real earnings that we expect to see. It looks like a median earner on around £27,500 a year will be about £360 worse off in 2022-23 than they were in this financial year. Someone earning around £40,000 will be getting over £800 worse off. As I'm sure everyone is now well aware, the OBR are forecasting the biggest hit to real household disposable income per person since comparable records began in the 1950s. The second big problem, probably a bigger problem, is that for those dependent on benefits, there was nothing in yesterday's package. The flat rate council tax rebate will benefit the large majority to the tune of £150, and the energy bill rebate will provide £200 in the short term. But that will still not be enough to offset the real fall in the value of benefits for most such households over the coming year. The 3.1% increase needs to be set against OBR expectations of inflation averaging nearly 8% over the year. And of course, the inflation rate experienced by poorer households will be even higher than that. Benefit levels will catch up with inflation next year, but that will be of little comfort to those budgeting week to week, or those who are unemployed this year and not next. To be honest, it's hard to understand the lack of action on this front. A couple of other more specific beefs with the policy announcements. First, while the increase in the national insurance floor is welcome, it's hard to think of any good reason to increase the rate of national insurance and cut the rate of income tax. That again benefits those living off pensions and unearned incomes at the expense of workers. The Chancellor has also not made the case for cutting the basic rate while also cutting the value of the personal allowance. It's certainly a regressive policy combination. Second, the absurdity of the idea that the national insurance increase, which will become the health and social care levy, is in any way hypothecated to health and social care, was laid even more bare yesterday. The cut in national insurance from yesterday's new measure is not leading to, and of course should not lead to, a cut in funding for the NHS and social care. And third, while promising some changes in business taxation in his autumn budget, Mr Sunak has done nothing to shield them from this year's planned rise in employer national insurance. That will add to their costs and to the downward pressure on real wages. One additional point worth making, the impact of the change to student loan repayment system on the public finances was laid out in the OBR's report. This will effectively act as an increase in taxes on middle-earning recent graduates, not graduates like me. To be fair to Mr Sunak, he's been caught in a bind. We are worse off than we expected, and he could never protect us all. What he has promised will offer substantial protection to low earners and, from last month's measures, some significant protection to those on benefits. His policies are overall progressive and will take significantly more from those on the highest incomes. He continues to just about meet his fiscal rules. However, he has not taken the opportunity to protect the poorest more fully simply by uprating their benefits more closely in line with actual inflation. His choice to increase national insurance rates and reduce the basic rate of income tax looks, to me at least, indefensible from an economic point of view, though one can see the political attractions. He continues, despite his rhetoric, to be a Chancellor presiding over a very big increase in the tax burden. What he did yesterday was not enough even to stop the expected tax burden rising yet further, though I think that is essentially inevitable. He is sharing the inevitable pain of continued bad news between public services and taxpayers, with benefit recipients suffering in the short term. He had tough decisions to make. Other choices were available. I'm now going to hand over to Carl Emerson, who will move on to Ben Zaranko and then Rob Joyce. I will then pop back up for questions, which, as I say, can come from the room, from Zoom, from Slido. Thank you.
Thank you, Paul. So I'm going to go through and describe what kind of hand the Chancellor was dealt yesterday morning and what he chose to do with that hand, how he chose to play it. So I'm going to start with the coming financial year, 2022-23. And in some sense, what might have been seen as the good news for the Chancellor was that he was expecting to get more in revenue in the coming financial year than he'd expected back in October. Revenues boosted by £33 billion in cash terms. But less welcome for the Chancellor was the fact that higher RPI inflation is feeding very, very quickly through to much higher spending on debt interest, and that's forecast now to be £41 billion higher in the coming financial year than was expected in October. So more than using up all of the additional revenue he was handed. What other forecast changes were there? Well, welfare spending was revised down by about £3 billion. Since October, we've seen lower than expected unemployment, we've seen caseloads coming in lower, and that £3 billion has been driven by the fact that amongst working age people in the coming financial year, we're now expecting to spend about £4.5 billion less as a direct result of that lower caseload. To put that £4.5 billion in context, the Chancellor could have said, well, I want to spend that on increasing the generosity of benefits for working age recipients. That would roughly have led to a 4.5% increase in the value of those benefits over and above what he did deliver. He then had some decisions he'd already made to add to the scorecard. In February, a month ago, he announced a package of energy measures which, taken together, increased borrowing in the coming financial year by about £10 billion. There's been some changes to the way in which student loans work, which are much less generous to universities and to graduates, which will save the taxpayer £9 billion in the coming financial year, less thereafter. And if he'd therefore not announced anything in yesterday's statement, he would have seen borrowing in the coming financial year higher by about £5 billion compared to what he had set out in October. So a modest increase overall in the forecast for borrowing, but an increase nonetheless, not the case he was given lots of money to play with. He decided to add to that increase in borrowing, plenty of scope for him to do that on a temporary basis if he wanted to. He allocated about £7 billion additional. In particular, the 5p cut in field duty that took place yesterday evening and the increase in the point at which you start to pay national insurance contributions, which will come in April. So overall, the deficit in the coming financial year is now forecast to be £13 billion higher than what was expected back in October. And clearly one of the very big driver of that is that debt interest spending line. So let's look at that in a bit more detail. So the chart here is showing forecast debt interest spending as of October as a share of GDP. We can add on that what the latest forecast shows. And you can see a huge spike up in the coming financial year. We're now expecting to spend about twice as much on debt interest as what we expected back in October. And the reason for that is the quarter of government debt, which is indexed to the RPI. That will push up spending very dramatically for a year, but when or if RPI drops back down to normal levels, that boost to debt interest spending will thankfully fade away. But you can see for the rest of the forecast horizon, we're still spending more on debt interest. That's really driven by the Bank of England and the fact that the cost of quantitative easing on the public finances is determined by the bank rate, which is now forecast to rise more quickly than what was expected in October. So at the end of the period, we're expecting to spend more on debt interest, but as a share of national income, it's really only putting it back to the level we were having to find prior to the pandemic. It's a one-off spike which largely goes away. So how does that change the Chancellor's picture for the medium term? If we take the 2025-26 picture, how did things look then? Well, in cash terms, he was handed even more revenue, £38 billion additional now in revenue expected in 25-26 compared to what he was expecting back in October. So that's an underlying growth in revenues that he could have allocated. Debt interest spending is revised up, nothing like the upwards revision we're seeing in the coming year, but still an additional £8 billion that needs to be found. Welfare spending is forecast now to be higher than was expected in October. That's, as Paul said, because when you have higher rising inflation, that does eventually feed through into higher spending on welfare benefits. It comes through with a lag. The February package of energy measures, actually that's a small takeaway because households are repaying essentially the cut to energy bills that comes this October. Other changes on the spending side, that student loan thing I spoke about, plus other changes, essentially net out. So if the Chancellor hadn't done anything yesterday, he would have been able to say that borrowing in 2025-26 was now on course to be £22 billion less in cash terms than was expected back in October. What did he choose to do with that? Well, essentially he chose to give away half of it. That's the national insurance change that comes in July, plus the cut to the basic rate of income tax, which is scheduled now for April 2024. And he chose to bank the other half. So the forecast yesterday, after measures, implied that the deficit in 2025-26 will be about £11 billion less than what was expected back in October. About half of that improvement emerges on the current budget side. That's the part of borrowing not explained by investment spending. That's the part that he has a particular fiscal target about. The other half is explained by what scores as lower capital spending in the government accounts. One big caveat to this is it all assumes that the 5 pence off fuel duties will be reversed in a year's time, and in fact thereafter fuel duties will go up in line with the retail price index. My view is it would be surprising if both of those things happened, but the forecasts assume that they will. If, however, Mr Sunak chooses to continue to freeze fuel duties from their current level, that will reduce revenues by about £5 billion in 25-26, further eroding away that post-measures change in borrowing. So, big increase in receipts here, forecast relative to what we expected in October. Where does that leave the tax burden? Well, back in October, this is the chart for the forecast tax burden as a share of GDP, showing it rising sharply over the next few years, combination of the economy bouncing back from the pandemic and the big tax rises that Mr Sunak announced last year. 2021 saw a bigger net tax rise being announced than in any calendar year going back all the way to 1993. But Mr Sunak also told us yesterday that his spring statement contained bigger tax cuts than any statement for 25 years. And we think that's correct. If you look just at the measures in yesterday's announcement, it's the biggest tax cutting announcement in any fiscal event since the autumn 1995 budget. But where's the tax burden headed after we take into account those new tax cuts that Mr Sunak announced? Well, it leaves the tax burden still rising, starting at a higher level and still rising and ending up at a higher level. And that's because of those pre-announced tax rises, plus the effects of fiscal drag, expected to bring in even more money. So essentially, he's able to pay for the tax cuts with the extra revenue he's getting from the tax system that was already in place, and still have an even faster rising tax burden. So I'm now going to go into a bit more detail about where that tax burden rise is coming from. So we're just going to look at tax-raising measures and tax-raising cuts first. So let's just look at the measures that Mr. Sunak has announced on income tax and look at what they're doing to revenues as a share of GDP over time. And what you can see is that the net effect of all of the things that Mr. Sunak's announced on income tax are bringing in about 0.5% of GDP by 2025-26. And I think what's really interesting from this picture is that in 2024-25, when the basic rate is being cut from 20p to 19p, you don't see the purple bar going down. That's because at the same time, Mr. Sunak is planning to freeze the personal allowance, to freeze the higher rate threshold, and there's enough nominal growth being forecast in the economy to essentially pay for that, more than pay for that cut to the rate of income tax. So in each of these years, you can see the income tax as a share of GDP being pushed up as a direct effect of measures being announced by Mr. Sunak. National insurance, you also see that bringing in more money. So despite the cut that was announced yesterday, far more important for overall revenues is the increase in the rate that was announced last autumn. And then we have the really big tax rise that was set out a year ago, the increase in corporation tax rates that's supposed to go up from 19 to 25% next April. Then there's some modest other changes. So that suggests that from measures now announced, we reckon the effect of Mr. Sunak's policy decisions is to push the tax burden up by about 2% of GDP. So how does this compare to previous chancellors? We published a graph showing that a couple of weeks ago. We can now update that chart. Now, for that, what we need to do is take the initial estimates of what measures will cost. We haven't gone back for all measures back to 1970 and produced an up-to-date estimate. We're just taking the initial estimate that was produced at the time they were announced and comparing chancellors. And that shows in this chart here how big a tax cut or tax rise you saw under different chancellors during their time in office from the initial scorecard at each fiscal event. And doing that exercise before yesterday's announcement, it looked like Mr. Sunak was increasing taxes by about 2% of GDP. So in 2 years, he'd announced about the same scale of tax rises as what Gordon Brown had done in 10. Because yesterday's announcement contains a tax cut, that brings that down a little bit. So he's now only the second biggest tax-raising chancellor on this measure on the periods shown since the start of the 1970s. Now, that's just the effect of tax-raising measures. The tax burden could go up because you're pushing up tax rates, but it could also go up because of underlying changes in the economy. It could just be the economy's growing in a particularly tax-rich way. So an alternative way of looking at this is to say, well, let's not worry about what the measures were. Let's just look at how the tax burden changed between the day you became Chancellor and the day you stopped being Chancellor. Now, we don't know when Mr. Sunak's going to stop being Chancellor, but let's just assume for a moment he survives in number 11 through till 2025. What we get there is shown by the dotted bars here. So if you take Gordon Brown as an example, Chancellor for 10 years, announced measures which increased the tax burden by about 2% of GDP, but presided over a period in which the economy grew pretty strongly, and that growth delivered additional tax revenues also worth about 2% of GDP on top. So in his time as Chancellor, the tax burden rose by about 4% of GDP. Under Mr. Sunak, if he goes through till 2025, you can see an increase in the tax burden just above 3% of national income, roughly speaking, about half of that being the direct effect of measures that he's announced, the other half coming from changes in the economy, delivering a boost to tax revenues as a share of GDP. So taking that all together, where does it leave the Chancellor with respect to his fiscal targets? Well, he has a whole set of those targets. One high-profile one relates to the current budget. It says, is he raising enough in revenue in 3 years? Does he expect to raise enough in revenue in 3 years' time to pay for day-to-day spending of government? And you can see here that the forecast as of October, the target year at the moment is 2024-25, so he was meeting that fiscal target. He was expecting to run a surplus on that measure. If we update it for the forecast produced yesterday, I would describe those two lines as pretty much running on top of each other, particularly when you think about the uncertainty in the economy at the moment. It's running slightly a slightly stronger position in the medium term, not making that much difference. Essentially, he's meeting his fiscal target, with what I would describe as a modest amount of wiggle room. And if you actually want to deliver a surplus in 2024-25, you can look in the OBR report, and it says, well, on the basis of past forecasting errors, given these forecasts, he's probably got about a 2/3 chance of success. That's slightly up from October, but this is all on the basis of past forecasting errors. You might think the current economic environment is more uncertain than normal. Maybe these are overstating his chance of success slightly. Turning to government debt as a share of GDP, he has a target to make sure that that's falling in 2024-25. He was just meeting that back in October. Lower borrowing last year and going forwards, plus higher cash terms GDP, means that debt as a share of GDP is lower and falling slightly quicker. So he's still on course to meet that target to have debt falling in 3 years' time. The OBR puts the chance of success on that actually happening at about 58%, so a slightly better than even's chance of success there too. So to conclude, the cash boost to revenues in the coming year that Mr. Sunak had is smaller than the increase in debt interest spending that he was faced with. So there was an underlying increase in the projected level of borrowing in the coming year. He chose to do some measures which pushed borrowing up by an additional £7 billion. Over the medium term, the story was a bit different. He got a bigger boost to expected revenues, and he got a much smaller expected increase in debt interest spending as the RPI is forecast to return to more normal levels. What the Chancellor essentially chose to do is bank half of that windfall and give half away in tax cuts. In terms of the tax burden, the pre-announced tax rises are now raising much more than he previously expected. So that meant he was able to give some of that away in new tax cuts, but still have a situation where the tax burden is rising sharply to an even higher level than was projected back in October. I'll now hand over to Ben, who's going to take you through the situation for public services.
Thanks, Carl. So moving on to spending on public services, which is an area that the Chancellor was largely silent on yesterday, but we, of course, won't let that stop us from digging into the detail a little bit. The key thing you need to bear in mind here is that when governments set out spending plans for public services and departments, they do so in cash terms. That means that departments bear the risk of what happens to inflation. If inflation turns out lower than expected, when those plans were set, they'll have more money to spend in real terms than they thought. But when inflation turns out higher than expected, those same cash budgets don't go as far. They're able to purchase less than was expected when the plans were set out. And that is, of course, what is happening right now. So the government's plans have become unintendedly so, but they've become less generous. Now, precisely how much less generous depends on how we measure inflation. Now, the measure of inflation we usually use for public spending figures and for the public finances is called the GDP deflator. And growth in that measure of inflation is set to be, under OBR forecasts, more muted than in CPI, which is a measure of inflation facing households. And precisely which measure you use gives you slightly different figures. So just to show you how those forecasts have changed, I'm going to show you first green bars here, which is what was forecast in October, and then red bars, which is what was forecast yesterday. So on the left, we have CPI. You can see a large spike in the coming financial year. The OBR revised upwards their forecast for CPI by more than 4 percentage points, and it's set to average 4% over the coming 3 years, which is the period covered by the latest spending review. If we look at growth in the GDP deflator, which, as I say, is the measure typically thought of as most relevant for the public finances, we see a similar pattern, but that upwards revision next year is much smaller, about 1/3 of the size, and inflation is set to average less than 3% on this measure, which means that if we use GDP deflator, the hit to real public spending plans is smaller. What really matters, though, is what happens to the costs actually facing departments and the extent to which higher inflation means that they're less able to deliver the public services which they're there to provide. Now, neither the CPI nor the GDP deflator is designed to just capture cost pressures on government, so it's natural that neither will capture it perfectly. In normal times, this doesn't matter too much. Right now, it perhaps matters a little bit more. The CPI will overstate the pressures on public services, partly because a big input into government cost pressures is pay, I'll come back to that in a moment, and we won't expect pay to be matching CPI, and also because governments agree contracts in advance in cash terms and things like that. The GDP deflator, on the other hand, is a bit of a tricky beast. It's quite hard to forecast. It has lots of technical things going on in the background that mean that it's perhaps slightly lower next year than you might expect because of these strange oscillations in the way government activity has been measured during the pandemic. We can come back to that in the Q&A if you want, but don't worry about it too much. The key thing is that depending on which inflation measure you use, the figures change. So in October at the spending review, overall day-to-day departmental spending was forecast or planned to grow by 3.3% per year. Now that varied across departments. Some, like health and social care, were set for more than 4%. Others, like defence, were actually facing real terms cuts over the next 3 years. Now, if we update to use the latest measures of the GDP deflator, you can see that they become less generous across the board, which represents the higher levels of inflation. And so higher inflation on that measure wipes out about 12.5% of the government's planned real terms increases. If we instead use CPI, which, as I say, probably overstates the pressures on public services, it wipes out more like half of that real terms growth. And if the government did want to maintain the level of real terms growth that it had planned in the spending review, it would have to find extra cash for departments. The precise amount depends on how you measure it. You're probably looking at something on the lower end of the scale shown on the slide there, maybe something like £4, £5, £6 billion perhaps to compensate departments this year for the higher than expected inflation. But will the Chancellor actually choose to do so? Will he choose to compensate departments? Well, first of all, I think it's important to say that yesterday wouldn't have been the appropriate time to do so. There's lots of things that still to be decided and hopefully will become clearer through the year, not least on inflation, but also on pay settlements, which I'll come back to. And also you could then make adjustments in the autumn, halfway through the financial year, based on the experience so far. So we're not saying that the Chancellor should have topped up his spending plans yesterday. But looking ahead, he sounded quite reluctant to do so at any point. He said that if there's any extra resources become available, he plans to use those for lower taxes, not for higher spending. But crucially, as I say, is this question of public sector pay. So pay makes up about half of all public service spending. What happens to that lies largely within government control, so the decisions made there will affect the cost pressures facing departments. They're not this exogenously imposed thing. So those public sector pay decisions will be made over the summer following consultations with pay review bodies or perhaps the early autumn. For some context, I'm going to show you here what's been happening to private and public sector average earnings in recent years. So the blue line here is for the private sector. You can see these big upwards and downwards movements during the pandemic. But the key thing on the right-hand side there is they're basically zero. In the 3 years to January, average pay in the private sector was basically flat after you adjust for inflation. If you look at the public sector, two key things. One, on the left, you can see that it was more or less tracking private sector pay in the 2 years prior to COVID, and that it's now falling in real terms and has been since the middle of last year. So that's important context. If you look at what's happened since the start of 2020, private sector pay, on average, on this measure, has gone up by more than 3% in real terms, just over 1% in the public sector. If we instead compare to January 2010, average pay in the private sector is more than 5% higher. Now, that's pretty unremarkable for 12 years, but even more remarkable is that the average earnings for someone in the public sector are 2% lower than they were 12 years ago, which is really stunning and is important context for potentially another round of real terms public sector pay cuts. So this is a tricky issue for the Chancellor. I think it's going to be one of the big stories of the summer and the early autumn. It seems likely that we're going to have positive cash pay awards, especially given the spending plans in place and the levels of inflation we're seeing, but below inflation pay awards seem a certainty, and that's actually what Simon Clarke, the Chief Secretary to the Treasury, alluded to last night. So we know that the Department for Education has proposed, for example, below inflation pay awards for teachers, average 4%, slightly higher for newly qualified ones, slightly less for more experienced teachers. But we expect inflation to average more than 7% over that period. And that's probably an example of what we're going to see across the public sector. The key thing for departments is if the pay awards exceed what was originally budgeted for and what they originally baked in to the spending plans they agreed with the Treasury. So the latest OBR forecasts have, as I showed you, CPI more than 4 percentage points higher this coming year than in October, when those plans were set out. They have an assumed public sector pay bill growth about 0.5 percentage point higher, and private sector earnings growth 1.3 percentage points higher. Now, the Treasury's official policy is to maintain broad parity between public and private sector pay. So you might think, based on that, they'll increase pay awards by the same amount as private sector pay is doing better than expected. So that would cost about £3 billion. But if there is no compensation for this higher level of inflation facing households, the average public sector worker will be hit to the tune of about £1,800 in real terms, obviously more or less depending on how much they earn. A quick moan about the health and social care levy, just to build on what Paul said in his opening remarks. So the levy is now forecast to raise more than £17 billion by the middle of this decade, which is a lot more than when it was first announced, because of higher inflation particularly. Rishi Sunak repeated yesterday that every penny of this is going to the health and social care budgets, straight to the health and social care budgets. At the same time, he announced some changes to national insurance thresholds, which I'm sure Rob will come on to, and that means that the specific 1.25% levy, if you think of it as a separate tax, will raise about £500 million less. The total cost of the change is about like £5 billion in that year. So these are all changes to how much the levy raises, but shockingly, the NHS budget wasn't changed, social care budget wasn't changed. There is really no relation between how much is raised from those tax measures and what is spent on NHS and social care. The hypothecation just is a useful myth for the Chancellor, and it's disappointing to see him propagating that in the House of Parliament yesterday. A quick note on changes to the student loan system, which are fiendishly complicated but produce some quite big numbers in the government's documents. So these all relate to the big package of reforms that were announced earlier in the year, including freezing of various thresholds and tuition fees, extending the repayment period by 10 years, changing the interest rate on loans, which, taken all together, effectively look like a big tax rise for recent graduates, and particularly a big increase in lifetime payments for those on low and middle earnings, and a big increase in how much of the loans that the government makes it expects to get back. So this is a little bit techie, but basically, before these reforms, the loans that the government was making, it expected to write off more than 60%. After these reforms, it now expects to write off more like a third. So that's a really big change, in large part driven by changes to interest rates, but also by higher expected payments for lots of graduates. And then one for the specialists and enthusiasts, perhaps, but this includes changes to the repayment terms for people who've already graduated. So cohorts who have already finished university and are already in the labour market. So changes with regards to those cohorts are scored up front. And that's why you get this big £11 billion number scored in year one in 2022-23 in the documents yesterday, in case anyone found that confusing. So just to sum up, higher inflation means that the government's cash spending plans are unintendedly less generous. A big determinant of how much less generous they're going to be is what happens to cost pressures, and a big determinant of that is what happens to public sector pay. Those big, and I should emphasise, difficult decisions will be due over the summer, and we should look out for those. The autumn budget, after those settlements have been agreed, after hopefully the inflation outlook is clearer, would be a natural point to adjust any spending totals, but the Chancellor has hinted that he's reluctant to do so if he instead prioritises pre-election tax cuts, which is what his rhetoric suggests. Public services are going to feel the squeeze. That's all from me. Thank you very much.
Great, thanks, Ben. So I'm going to talk about what the outlook is for real incomes and the role within that of measures that we've heard about on personal taxes and benefits. And I'll start with those measures. And I'll start with the short term, thinking about the coming year, and in particular with changes to direct taxes, which make up most of the chunky measures. So there's some stuff we already knew about. In particular, freezes to the income tax thresholds, the personal allowance, and the point at which you start paying the higher rate. So that was instead of what would have been the default of increasing those by about 3% next month. And these are now expected to raise about £3 billion next year. And we also knew about, as Ben's already mentioned, the increase in national insurance contributions, which will morph into something called the Health and Social Care Levy, also due next month. And that is set to raise a lot of money, about £17 billion next year. Now, yesterday, we had a new announcement in this area for a tax cut in July. And this is in the form of the increase to the threshold, the point at which you start paying national insurance for both employees and the self-employed. One difference here between this and the rate increase that was already in the books is that businesses, the employer NICs, the employer side of the NIC system is not affected by this new tax cut, even though employer NICs will be rising, the rate of employer NICs will be rising in April. But this tax cut is fairly significant and costs about £6 billion next year. So let's put all that together and think about what that means for people on different earnings levels in 2022. So starting with those things that we already knew about. These are the freezes to the thresholds and income tax and the increase in the rate of NICs. So here you see losses for anyone earning about £10,000 or more, so that's anyone earning enough to pay direct taxes. Increasing in earnings because the NICs, first of all, because the NICs rate increase costs you more in cash terms the more you earn, and you can see that the losses sort of step up above the two thresholds that are being frozen, the two income tax thresholds that are being frozen. Now, yesterday we had this announced increase from July to the point at which you start paying national insurance contributions. So this is, as Mr. Sunak suggested, and as he suggested that the IFS had suggested, this is within measures that you can take with respect to income tax or national insurance, the most progressive thing you can do, because you're giving away money all the way down to those with only just enough earnings to pay these taxes at all. And you're also giving the same amount of money to the lowest earners, essentially, as to everyone else. So it's a flat rate giveaway of in this case, £356 on an annualised basis to all of these people, as opposed to, for example, a rate cut, which would give more cash to those earning more. Now, this is only coming in July. So one might want to make this a bit more comparable in some sense. You might want to think, oh, sorry, let me just say, there's a crossover point from July, what this implies, which is that anyone earning between that £10,000 threshold and about £32,000 will, as a net result of all this, be paying, be gaining from these changes next year. But anyone on more than £32,000 will, as a net result, be paying more tax overall. The increase of the NICs threshold is only coming in July, so we might want to think about the financial year as a whole, to which that tax cut only applies for 1 quarter of it. So if you scale that down by a quarter, essentially, you can think about what people are paying in income tax over the whole financial year. So in those terms, the gain from yesterday's announcement over the whole financial year is about £267 for everyone above the NICs threshold. And that crossover point comes down. So in other words, over the next financial year as a whole, anyone on more than £25,000 a year will be paying more direct tax than they would have been paying without any of these measures. Okay, so some other measures coming in the near term, which I will be pretty brief on. We already knew about the announcements last month aimed at trying to cushion the blow from rising energy prices in particular. Essentially a near universal package, giving in the short run about £350 to most households, although 200 of that is planned to be recouped in subsequent years. And also pre-planned freezes as usual to fuel duties, and also to alcohol duties. A new announcement was actually a cut to fuel duties of 5p, which took effect yesterday evening, as you'll probably know. So not just freezing it, not just not increasing it in line with inflation, but actually cutting it by 5p. Allegedly for 1 year only, which we'll come back to. But in terms of the short term, that's the main measure that we heard about. So let's put all of that together and think about the distributional effect by household income of tax and benefit reforms in the coming financial year. So again, the short term. I will include here, there are a set of increases to in-work support for those on universal credit that came in just at the back end of last year. They were announced in the autumn budget, but the government deliberately rushed them in rather than waiting until April, so I think it's fair to include those here too. But essentially we're looking at the effects of reforms in the pipeline in the near term, in the coming financial year. So, starting with those that we already knew about, that were previously announced, Essentially, we have a pattern like this, and it's for the following reasons. You had fairly uniform gains in cash terms from the energy package, the measures that I just mentioned that were announced last month. But then we have losses from the increase to national insurance and the freezes to income tax threshold, and they tend to be concentrated at the top, towards the top of the distribution, where more of those taxes are paid. And at the bottom, we had the reforms that I just mentioned that have just come in, the increases to universal credit for some families on low earnings. So, a fairly clear pattern looking at those previously announced measures. And if we add in the ones that we heard about yesterday, we've got the rise to the NICS threshold coming in July and the fuel duty freeze. In combination, they give a little more cash to higher income groups. But this is just a smaller package, and the distributional impact is less stark than what I've already shown you with the yellow bars. So the main distributional impacts putting this together come from the things we'd already heard about. And you can see it's a pretty progressive set of measures overall. The light grey line shows you the total in pound terms, and then on the right-hand axis we can plot this as a proportion of income, where of course that makes it look even more progressive as a proportion of income. Okay, so, and to quickly go beyond 2022 as well, because there's quite a lot happening beyond 2022. So first of all, we already knew about continued freezes to these income tax thresholds, personal allowance and the higher rate threshold, up to and including 2025-26, so a 4-year freeze in total. The main thing to say about this at this point, I think, is that these are far bigger policies than was intended, because inflation has risen so much. So these were basically, the government was essentially setting tax thresholds in nominal terms several years in advance without knowing what inflation was going to be. And as a result, the real cut is going to turn out very differently to what it thought, up from the original intention of about a 7.5% real cut over these 4 years to something more like 16% over those 4 years. And so similarly, the expected saving from these measures has more than doubled to about a very large now, about £18 billion a year by 2025-26. It's worth mentioning as well that after increasing the NIC threshold in July, which was announced yesterday, it will then be aligned with the personal allowance, which is a broadly sensible feature of what will be the new system. But as a result, it will, like the personal allowance, be frozen subsequently. So that effectively claws back some of the initial giveaway from raising the threshold, because it would otherwise have it would previously have gone up in line with inflation each year. So that looks like a slightly less generous policy longer term than in the short term. And then we had a newly announced income tax cut to come in by strange coincidence somewhat closer to the next election, which is a 1 penny cut to the basic rate of income tax, which will cost about £6 billion per year. So, again, to stick with the direct tax side of things for the moment, where a lot of the action is, and now looking out to 2025-26, I want to show you again a similar picture to what I showed you before, annual earnings on the horizontal axis, and giving you a sense of what these changes will mean for different kinds of earners. So this shows you the annual gain or loss. Sorry, it's not the annual gain or loss, it's the annual, should say the annual increase in taxes paid, apologies, by 2025-26 as a result of all of these direct tax reforms. Given the new inflation forecasts, which of course are very high, but without any of the policy action that was announced yesterday. And so here you can see pretty chunky increases in national insurance and income taxes paid, again increasing at around the thresholds that are being frozen. All of these losses have got significantly bigger as a result of higher inflation, meaning those freezes are a bigger deal. Now, presumably partly as a kind of response to that, we had some cuts to these taxes announced yesterday. So the increase in the NIC threshold, and then 2024, the cut to the basic rate of income tax. So that limits the losses, but for pretty much everyone, overall it's still a loss. So which is another way of saying that in combination with the NICS rate increase, the fact that inflation is now so high, and that means that freezing the income tax thresholds is such a big deal, means that almost all workers will still be paying more direct taxes overall by 2025, even despite the giveaways that we heard about yesterday. Beyond 2022, there are some other things happening. A general theme is that packages tend to look less generous once you extend the time horizon. In particular, a couple of sort of temporary things are expiring or being recouped, so that £200 flat rate support for energy bills is set to actually be clawed back in subsequent years. And also, as I mentioned, allegedly, the cut to fuel duty will be unwound in a year's time. I've demoted, for brevity, demoted a chart which helps illustrate how implausible we might think it is that is only going to be temporary. But it will be there for your delectation online if you want to look at it. But that is, of course, I think we have good reason to think, to be sceptical about whether that will really be a temporary cut. Taking that at face value for now, though, it sort of drops out, that cut drops out of the analysis once we wind forward to the longer term. And so doing that now, let's show you a similar picture to what you've already seen, the distributional impact of reforms by household income, but extending this to the long-run impact of everything that's in the pipeline now. Okay, so here we've got, as before, a pretty progressive-looking picture overall. Essentially now the losses towards the top are growing a lot compared to the shorter-run picture I showed you, largely because of these freezes continuing. These freezes to thresholds continuing, and in combination with high inflation, that meaning a bigger and bigger takeaway in tax terms, which is concentrated at the top. And then in terms of new measures, we've had, I should also say, we also would have good reason to think economically that the employer NICS increases, once we think about the long term, would be takeaways from households too, because ultimately we think that these would affect the wages that firms are willing and able to pay. In terms of new announcements, yesterday there was the cut to the basic rate of income tax, which tends to mostly benefit those towards the top. But it's just a smaller deal than everything that I've just talked about. So overall, again, we have this quite progressive picture with pretty chunky losses towards the top of the distribution. And again, as a percentage of income, we see that progressive picture. So, more briefly, I want to talk a little bit about incomes more generally. But we talked about policy measures, which will affect incomes. But of course, there are many things that would be happening to real incomes, even in the absence of any policy measures. And much of that is to do with these big increases in inflation that we're seeing. And so, first of all, one consequence that that's having is for real earnings of workers. This is from yesterday's release, showing you forecasted year-on-year real changes in earnings. And you can see that the OBR is expecting a real year-on-year fall in earnings of close to 3% over the coming year, which just about eclipses any year-on-year change we saw in the financial crisis. Although in the financial crisis we saw several years of fall in earnings, it should be noted. So this is the sharpest fall in some sense since before then, but not the biggest overall perhaps. But a very, very sharp fall over the coming year, and the biggest we've seen under this forecast since the 70s. Apart from that being important when thinking about the kind of adjustments that households are going to have to be making over the next year to their change in circumstances, also we should remember the bigger picture of what's happened over a long period now to real earnings, and really this will just extend this protracted period we've had where we're still struggling to get significantly past 2008 levels of earnings, even according to the latest estimates by the mid-2020s, which is extraordinary. And the gap between average earnings levels that we might be seeing in the mid-2020s and what we would have expected had what used to be normal rates of growth continued after the financial crisis has got to something like £11,000 per year, which starts to feel unreal, but that's what happens if you keep having lower than expected growth for a very long time. So also just to put in context a little bit, put some of these pieces together a little bit for some kinds of example people. So changes in inflation, changes in earnings, changes in policy. And starting with some examples of some working households, I'm going to take first of all a median earner and a relatively high earner at about the 70th percentile of earnings, and break down changes in real income post-tax that we would expect to see over the coming year, or in the coming financial year relative to the previous financial year. So we're going to see falls in real earnings, as we've just seen. We're also going to see further takeaways from the tax rises, as we've talked about. We're going to see a giveaway that is attempting to address some of that pain in the form of those energy measures that were announced last month, but nevertheless, the net effect for these households is going to be a very difficult year, a fall in real post-tax earnings at the median of something like 1.5% and about 2.5% for that somewhat higher earner. Okay. Taking someone full-time on the minimum wage, it looks more benign. The minimum wage is going up by 6.6% in April, which initially looked like a really big increase. It now is still set to be lower than inflation, but it's significantly better than what many earners will experience. So they will just about, under current estimates, be able to maintain their level of living standards for the next year, at least, in combination with that energy package. Someone full-time on the national living wage and on universal credit, it's a little bit different. So someone who's also on universal credit, they did benefit from the increases to in-work support that I mentioned happened just very recently. But if we're comparing next year with last year, there's a couple of other things to say. One is they've lost the uplift in universal credit, the temporary uplift that they were still getting for half of the last financial year. But also, very importantly, their benefits aren't keeping pace with inflation. And that's not because of a deliberate, in some sense, cut. It's because we uprate benefits in line with a lagged measure of inflation. 3.1% is the applicable rate that will be used to uprate benefits next month. But actual inflation has now risen to 8%, or will have risen to 8% next year. So their benefits are falling in real terms. Okay, so they're seeing a fall in income as well. And that's the last point I just want to dwell on. Of course, that point is most relevant for those who are most benefit dependent. So if you take, for example, workless households, here I've got a workless single parent example. I want to show you the path of their real benefit levels on a quarterly basis since 2019 Q2, so that's just after the last sort of pre-pandemic uprating of benefits in April 2019. And I want to wind that forward quarter by quarter and show you what's happened. So benefits were uprated in April 2019, that's where I'm starting the picture. The real value of those benefits stays pretty flat in the year after that because inflation's pretty low, so not much is happening to the real value of those benefits. Then the following April, there's the usual inflationary uplift, but also more importantly, the temporary universal credit uplift that was implemented at the start of the pandemic. Okay? Then we wind forward a little bit more. For the next year, again, inflation's pretty low, so the real value doesn't really change much over that year. We start to see a bit more evidence of rising inflation as we go through 2021. So we do now start seeing a little bit more of a fall in the real value of benefits quarter by quarter. And we particularly see a big drop off in the autumn when that temporary uplift was withdrawn. Okay, so now we wind forward to the end of the current financial year, to basically about now. So here you can see, despite the fact that benefits are uprated next month, their real value is still significantly lower than it was before the pandemic, and that's because we're not actually keeping pace with the current rate of inflation as we uprate benefits. And inflation is going to be really high again for the rest of the year, and so we're going to get to March 2023, and the value of these benefits would have eroded even further. So they'll, at this point, probably be about 9% below where they were pre-pandemic. About 17% below where they were at the sort of peak here in terms of when they were still getting the uplift, which is relevant for thinking about some of the adjustments these households might have to be making very sharply. So it won't be until April 2023 when the benefit system finally catches up with inflation and we finally get back to a real benefit level that's something like what we started with at the start of the pandemic. Okay. So to conclude, probably about time. We've had a substantial package of help for this year, both pre-announced and a little bit and from announced yesterday. Things look less generous thereafter, which you might think is reasonable. We're most focused right now on support during a very difficult next 12 months, but it's important to bear in mind that some of these things look much better in the short term than the long term for households. The freezes to income tax thresholds are now a very, very large policy. And in combination with that NICS rate increase that we knew about mean that almost all workers will see a tax rise on their earnings over this Parliament. And it illustrates a liability of setting policy in nominal terms in this way. There are quite clearly directed efforts to help low earners going on. We've had these increases to UC that I mentioned that have just happened. We've got a minimum wage increase about to come in, and the next threshold that was increased that was announced. It was today when I wrote the slides, but it was actually, it was of course now yesterday, which I failed to foresee. Putting a lot of that together, we do get this picture where the reforms that have been made to taxes and benefits, the new policy measures are pretty progressive. But one very important thing that leaves out, of course, is that the impact of inflation is probably worst of all for those dependent on benefits, and that's because there's an existing policy we have, which is that benefits don't, in real time, or anything very close to real time, keep pace with inflation, and the government has chosen not to do anything about that. So, whilst it doesn't really seem optimal to set policy in nominal terms a long way in advance, it also seems less than ideal to be using lagged measures of inflation to uprate stuff when you don't need to, and very far short of ideal right now when inflation is changing so quickly. But overall, an extremely challenging period ahead for living standards. Most groups are going to struggle to maintain their material standard of living next year compared to last year. And I'll stop there.
Great. Well, thank you to Rob, to Ben and to Carl. I now need to try and manage questions from all sorts of places from the room, which I'll start with, from Zoom. If anyone on Zoom would like to raise their hand, please do so. And we have lots and lots of questions on Slido. So is there anyone in the room who would like to ask a question? I think we've beaten them into submission, yes.
Richard Partington from The Guardian. The borrowing figures come down and the headroom that the Chancellor has in 2025-26 is there. In previous years, there was a Chancellor who said that he would fix the roof while the sun is shining. If Rishi Sunak is cutting the deficit, is he fixing the roof while it is currently raining with high rates of inflation squeezing household incomes?
Carl.
Well, in the coming financial year, the change since October underlying is to increase the deficit, and Mr Sunak chose to add to that with some additional measures. So he, when faced with a deficit that was bigger than he expected in the coming financial year, when the cost of living crisis is going to be hardest, he did choose to add to that deficit. I think in terms of priorities over the medium term, I think what's more questionable is, I can see why one would really like to have a cut in the basic rate of income tax in April 2024. Given uncertainty, on economic grounds at least, I'm not sure why you'd want to announce that now rather than wait until you've got much more information about how the economy is faring, how the public finances are faring, how households are doing, how public services are doing, before committing to that kind of tax cut in advance.
Sorry, you may have already done this, but could you give us the pounds and pence sums for how much the Chancellor's reaping from the higher thresholds, from the freeze in the thresholds for income tax, versus how much he's giving away in a 19p rate rather than a 20p rate?
Yeah. I mean, obviously, in terms of how that affects households, it depends on how much they're earning. Do you mean in aggregate or for particular? Yeah. Okay, so
yeah.
Right.
So in 2025-6, the freeze in thresholds is now expected to be raising him about £18 billion. The cut to the income tax basic rate is expected to cost about £6 billion.
So it's a 12 billion tax increase, my maths says.
You're right.
Not directed for nothing. Anything else in the room? Anyone on Zoom want to raise their hand? Or just start speaking? Nope. Well, I will move in that case to to the questions on Slido, which there are quite a lot of people want to know whether there are any women at the IFS. Well, the answer to that is about half the professional staff are women, and we're actually very proud of the fact that, very unusually for an economics organisation, the majority of the senior team are women, and we have no gender pay gap. And as Helen Miller explains in an answer to that, at least a couple of the women who might have been doing this are currently unwell. So we simply use the people who work on this stuff on any particular moment. Other times we have entirely female panels. So I'm sorry that we've resulted in that question, despite what I think is an exemplary record on our gender diversity. Should the Chancellor have announced a windfall tax on oil and gas companies? And what are the minuses and pluses of such an action? Well, I might ask Stuart to say a word or two on this. I think the answer is that, on the whole, windfall taxes are not a great idea, because it's rather good to have a transparent and predictable tax system, and in putting in place windfall taxes willy-nilly can create problems for investment and certainty. That said, we've had in my lifetime at least 2 windfall taxes, one on the banks in the early 80s, one on the privatised utilities in the late 90s. The case for a windfall tax this time, I think, is probably relatively strong, given that this is an extraordinary moment for producers of fossil fuels who are making extremely big profits through no work of their own. And I think you probably could, without too much damage, implement a windfall tax under those very specific circumstances. A much better policy would have been to make it clear that the tax rate would rise at a point when profits or prices went above a particular level. So I think the answer is, had there been a windfall tax announced, we wouldn't have been enormously grumpy about it. I'm still looking at Zoom and into the room if anyone wants to ask questions there. Otherwise, I will continue to go through the very large number of very good questions on Slido. There's a question here which I think, Carl, you answered. Was yesterday really the biggest net cut in personal taxes for 25 years, as the government claims?
Yeah, so just looking at all tax measures, not personal ones, if you just take the scorecard from yesterday's announcement, it is a big net tax cut from the new things that Mr. Sunak told us about, and it is bigger, I think, than in any fiscal event that we've seen since autumn 1995. So a very big, the direct effect of new measures announced yesterday, big tax cut. Crucial context for that. If you take all of the announcements in the last calendar year and add them up, that's the biggest set of tax-raising measures in any calendar year back to 1993. And those tax-raising measures are now expected to raise a lot more than was thought last year, because inflation is so much higher. So that's how you can have a statement which is looks like a big tax cut, but it still delivers a bigger rise in the tax burden than you previously expected.
Okay, I'm still looking. Otherwise, I will go again to the questions. There's one from Faisal Islam at the BBC. Says, does the Chancellor have an index problem? Could there have been a mechanism to switch the rise in benefits that is likely to come in years to come to now? What cost to increase by 6% now and public sector pay? I think the answer is the Chancellor does, in that sense, have an index problem. He could have decided to switch to increasing benefits by a different number. I think he has a practical problem in one sense. It would have been possible actually to announce yesterday an increase in universal credit and bring it in really quite quickly. He actually changed the taper rate in October, and I think it was within the month it was changed. Legacy benefits and state pensions take staggering amount of time to change. If you talk to senior officials at the DWP, they will tell you that a lot of it has to be done by hand, and it takes many months to make a change, astonishingly. But he could have made this announcement earlier in the year. He could have, as he has done with national insurance, make the announcement now and make the change later in the year. So that's clearly an option that was open to him. And of course, the long-term cost of bringing forward the indexation could have been zero if that resulted in a smaller increase next year, to avoid the downs and ups that Rob showed on that lovely but rather depressing final chart of his. What would the short-term, do we know, what is the short-term cost of sort of every extra 1% on the benefit? If it's for all benefits, it's presumably about 2 billion, given a total benefits bill of 200 billion.
Like that,
Yeah, that includes pensions.
That would include pensions. So if he wanted to increase all benefits, including pensions, by an extra 1%, it would come at a cost of around 2 billion a year. We have worked out in our heads very quickly. It's a significant change in the short run, but as I say, not necessarily in the long run. And of course, the current policy of increasing benefits in line with inflation, as it was in the last September, is absolutely fine when inflation is low and stable. But when it's extraordinarily volatile, as it is, it becomes much less fine. And I think, as everyone has said about this package, that the lack of action there was probably the biggest problem with the package. Carl, there's one which I'm going to send to you. It says, given this increase in debt spending, shouldn't we be more careful about borrowing? A few years ago, people said higher interest rates would only come with higher growth, so don't worry, but that doesn't seem to have happened this time.
Yeah, I mean, if we looked at the forecast as of October, it was in some ways astonishing. We'd borrowed all this extra money through the pandemic, much higher debt, and yet the outlook for spending on debt interest was not changed compared to what we might have expected prior to the pandemic. So more debt, but not expecting to spend more on debt interest spending over the medium term. So question, does that mean all of that debt came for free? The answer is no. The cost is we are more exposed to increases in the cost of debt, to the interest rate we pay on that debt, and in particular exposed to that going up in a world where we don't get more revenues alongside it. Higher spending on debt interest that comes alongside higher real growth would be a good result for the public finances overall. I think yesterday was one example of a change in the forecast which doesn't have that effect. Even ignoring next year's spike, if you look in the medium run, we're now expecting to spend a bigger share of GDP on debt interest spending, not one that's alarmingly high. Let's put it back to pre-pandemic levels, but it's higher than what was forecast before the pandemic started. So it is a bit more burdensome. So Mr. Sunak and indeed his successors are really going to have to keep a careful eye on that debt, managing it carefully. And one thing that will certainly be keeping them awake at night is the possibility that we end up having an increase in the interest rate on the debt and not getting stronger growth, stronger revenues alongside it.
Andy Verity here.
Hi, Andy Verity from the BBC. Just to follow up on that, Carl, a lot of that money that's paid out in debt interest, isn't it recycled in the sense that it's going to the Bank of England and back? And to what extent is the government in a position where it might be able to just say, no, we're not going to pay the additional interest on the debt that we owe to ourselves?
Yeah. So no, the debt interest figures I'm referring to don't count as debt interest payments, the money that's being paid on gilts that are held by the Bank of England. But what they do count is the fact that to buy those gilts, the Bank of England has had to raise money from the private markets, and on that it pays bank rate. And that's what's costing roughly £8 billion a year more in the medium run, because we now think, the markets now think, that bank rate is going to be higher than what they thought back in October. So as bank rate goes up, as the Bank of England starts to unwind quantitative easing, which it's now starting to do, that part is going to become more expensive to the Treasury.
Okay. It's a question about the triple lock, Carl. What impact is what's happening at the moment going to have on what the Chancellor could or should do about the triple lock on pensions?
Well, in periods when earnings are growing very weakly, when inflation is high, I think there is a good case for protecting pensioners from that, from a drop in living standards. And so rather than earnings indexing those pensions in those periods, I think there is a case for giving them price indexation and seeing the state pension rise relative to earnings. I think the problem with the triple lock is what comes in other periods of time when if the state pension does rise relative to earnings in bad years, there's no attempt, no mechanism for clawing those gains back in better years. So over the next few years, pensioners will be getting an increase in the state pension that's in line with inflation, albeit with a lag. I think there's a good case for that. over the long run, it will mean that the state pension is further ratcheted up as a share of average earnings, which is not something we can keep doing over the very long term. At some point, we'll have to decide to stop that.
There's a question here. Paul, was the IFS quote used by the Chancellor on NICs when compared to your views expressed about the real impact on tax and incomes unhelpful? So I think what the Chancellor said was something like the IFS has said that the best way of using the tax system in a progressive way or to help low earners was to increase the NIC's threshold. I think that's broadly right. As pointed out to me last night, there are some small things you could do that are more progressive, like abolish tobacco duty, but that's probably not the sort of thing he had in mind. But broadly speaking, if you want to help low earners through the tax system, then increasing the point at which you start to pay national insurance contributions is probably the best way of achieving that. Of course, you do it much more directly if you increase universal credit or other benefits, but there are obviously differences in that. But yes, he was broadly correct, and we didn't have a problem with what he said at that point.
Also, of course, they have just also increased in work benefits, which is one of the things that is more targeted at low earners than a NICS cut.
Ben, I'm going to ask one of you here. It says millennials. It's not just because you're the nearest to a millennial we've got here, but millennials can't seem to catch a break economically. I've read the Chancellor is changing student loans and that will earn him more. How much is he making and how are graduates going to be affected?
There is a distinction to be made between the accounting treatment and how it affects borrowing, which is fiendishly complicated and makes my head hurt, and how much it will affect sort of graduates in any given year. It's, as you said earlier on, Paul, it only affects recent graduates, not people like yourself. It will mean that when there's lots of things going on, but one of the main ones is that the thresholds above which you start paying back your student loan at 9% will be frozen rather than increasing. That means you'll be paying more back every year if you're a graduate. That looks and smells and feels a lot like a tax rise. You'll also have your repayment term extended by 10 years, which means you might be paying that for much longer. And that sort of gets at one of the things here, which is that it's about how much people expect to pay back over their lifetime, not just in any given year, that affects the impact on the public finances. So it's basically a discounted stream of future payments, which is scored in the government accounts, which is why you get lots of it up front, even though the actual cash may not flow for many years or even decades to come. So yes, I think also it relates to something you hinted at, Paul. If you're thinking about this generationally and looking at millennials versus baby boomers or older, the Chancellor's chosen to increase national insurance rates whilst cutting income tax rates. Of course, income tax is paid on pension income, national insurance is not, so it's a further increase on earners, offset by a partial tax cut for those receiving their income from pensions. So there is a generational element to this as well.
Which Ben feels even more strongly than I do. So there's a question about whether is it right to say the tax and benefit gains at the lower end of the distribution will be more than wiped out by inflation in 2022-23? I think the answer to that is yes, isn't it, Rob?
Broadly, yes. I mean, so the main comparison that's relevant there is between the extra support that those households will get from the broadly flat rate package that was announced last month, so basically an extra £350 next year from those two energy-related, nominally energy-related measures. The comparison between getting that much extra money with the shortfall that they experience from the fact that their benefits are not being uprated in line with the actual rate of inflation. So inflation is going to be 8% next year, but their benefits are going up by 3.1%. There's a 5% shortfall. So the question to a large degree boils down to how does that 5% shortfall compare to £350 that they're getting given? And the answer is, for most of those households, the 5% shortfall is a lot larger, certainly larger, and in many cases a lot larger than £350. So some benefit recipients who don't get that much in benefits because of their circumstances, so most likely those without kids and disabilities, for some of those, £350 would sort of more than compensate for not actually getting their benefits increased in line with inflation, but for most it wouldn't. And that would be particularly the case for those with high assessed needs and therefore getting lots of benefits, like the disabled or those with children.
Yeah, and I think it's worth saying, isn't it, that pattern has changed in the last month as expectations of inflation have gone up, so that I think we were saying a month ago that the picture was a little bit more positive for benefit recipients if inflation had stuck at 6%, but at 8%, and particularly at higher levels for people on benefits, then the average loss is very much there. Carl, is higher inflation positive or negative for the public finances?
So it depends exactly what kind of inflation you're getting. The forecast yesterday showed that if we just narrowly focus on measures of government borrowing, it was bad for government borrowing in the coming financial year because of the massive increase in debt interest spending, far outweighing the increase in cash receipts. And in the medium run, it was good for the public finances because the effect on debt interest spending is much smaller then, and you still get the revenue. But stepping back from all of that, and if we start thinking about how real resources are allocated, if we have inflation and it does turn out to be kind of good for the public finances, it's probably just an artifact of the fact that we set public service spending in cash terms. Those entitlements are fixed unless the Chancellor chooses to do something about it. If nominal values go up in the economy, you're just choosing essentially, or the implication is you're just ending up less generous in terms of public service spending. So you could have actively decided to be less generous to public services in real terms and got to the same position. I think the worry is that when you get kind of surprise inflation coming along, it leads to resources being allocated in a different way to what you'd intended. You're not making an active decision. So, did the Chancellor really decide yesterday that he wanted to spend less on defence, health and schools in real terms in the coming year than what he'd planned in October? Or is that just a function of the way in which the spending process works?
There's a very easy question here which says, will the live stream be saved to watch later? To which the answer is yes. If inflation is 6-7% in September, this will be the rate used to apply to benefits in 2023, giving a real rise if inflation is lower next year. The answer to that is yes, that's exactly what's happening and exactly why it could and, in our view, should have been smoothed out. So as Rob showed, you get a big reduction in the real benefits that people are getting just before next April, and then it goes back up to where it was 3 years ago. So that is the problem with the way that indexing works at the moment with volatile inflation. There's a question here with quite a lot of likes, which I haven't asked so far because I'm not sure if we can answer it. And the question is about household savings. Do we have an analysis of the distributional impact of cost of living given different levels of household savings? I suspect the answer is no. But
not as such. I mean, so I can say maybe a couple of informative things. I mean, so as we've said, typically for the lowest income households, we would be expecting their incomes to fall in real terms, presuming that they weren't already saving some of their income, and most people on low incomes don't save much or anything. Then that would mean that they would have to start making adjustments of some kind. And most of an amazing fraction of all households actually have little in the way of, or nothing in the way of liquid savings, as a stock of liquid savings to draw on. That's certainly true towards the bottom end of the income distribution. So, borrowing would be one of the ways that people could try to respond to that, and they could try and get help from family and friends, and there are various things that we know that people tend to turn to when they're in real financial difficulty. But that would be the kind of thing you'd be looking at, because this is a group with little savings to start with, falls in real income, and probably starting from a position where they weren't putting more money in the bank every month in the first place.
Ben, you're not going to thank me for asking you this question, but there's a question asking why such a big gap between the GDP deflator and CPI.
Yeah, there's actually a very helpful paragraph on this in the OBR's Economic and Fiscal Outlook, so I would direct Alan's screening towards paragraph 2.27, but there's basically three big things. One is that imputed rent features in the GDP deflator but not in consumer price inflation, and that's lower than other forms of consumer price inflation on things like toys, food, whatever, and so that brings it down. There's a second thing which is to do with the fact that they're just measuring different things, and trade enters very differently, and so the fact we net import energy, which is where a lot of the price rises are concentrated, means that what they call the import deflator is much larger than the export deflator. What that does is brings down this measure of price rises in GDP because of sort of national accounting. And then the third thing I think, which is actually the most important one, is that the GDP deflator picks up changes in the price of government consumption. And that's been basically, it's made havoc with during the pandemic when the ONS admirably tries to do a really good job of measuring government inputs and government outputs in quite a complicated way. What that means is that we were spending a fortune on the health service and on schools, but we basically weren't teaching any kids and we weren't treating any patients, which looks like the price of each unit of teaching and hospital care has gone up loads. Now we're spending a bit more, but we're treating way more patients and kids are back in school again, which makes it look like the price of each unit of that has now fallen. So on the GDP deflator number, the price of government consumption is actually falling this year, despite the inflation that we see in the economy. So that brings the number down as well, which is why you might think the GDP deflator perhaps understates the pressures on departments. But basically, there's lots of things going on. There are different measures trying to capture different things, and I refer you to the OBR.
Wise words. Question from Brian Palmer. Do you think the alignment of NICs with personal allowances means the OTS has got its wish, or will it prove to be transient? Well, we had personal income tax allowance and national insurance allowances at the same level up till 2010, and then, of course, this government delinked them as it increased the income tax personal allowance without increasing the threshold for national insurance contributions. And something we said year on year was that you probably want to increase national insurance contribution threshold if you want to help lower earners at the same time. So another reason we think it's a good thing to bring those together. How much that helps with simplicity, I think, is open to question, given that national insurance remains a weekly tax, oddly enough. All of it is actually defined in weekly terms, not in annual terms, and it remains on a different base from income tax. So in terms of bringing the two systems together, this is a teeny step, shall we say, rather than a large stride towards any kind of integration. I think we are getting towards the end of our time, and I'm just looking through questions. What is the impact for pensioners? I think we've sort of covered. I mean, I think the key part of what we've seen is that state pensions clearly are going up only by 3.1% this year, alongside other benefits. So any state pensioner who is dependent largely on the state pension is going to be losing out this year. And one of the things I think is quite interesting is that even for those on defined benefit occupational pensions, quite a lot of those are only limited price indexed. So they may not, even their occupational pensions may not be going up in line with inflation. More importantly, probably, increasing numbers of pensioners either have annuities, nearly all of which are not index linked. So anyone who's bought a non-index linked annuity is going to be having a really big long-term hit to their income, or maybe using their defined contribution pensions or other savings as a savings pot. And to the extent that that is invested in stuff that's not going up as fast as inflation, again, that will be a hit to them. That's less of an issue now than it will be in 10, 20 or 30 years' time, when essentially, other than those retiring from the public sector, the only income or assets that pensioners will have will be essentially savings pots. And this is one of the things I think that worries us most about the direction of pension policy at the moment, which is that it lands all the risk on the individual. And we've just gone through a period where that risk will have crystallised in a big way for those reliant on those pots of cash. We are at 11:45, which I believe is the advertised ending moment for this. So thank you all very much, all of you in the room and everyone listening remotely. If you have further questions, don't hesitate to email my colleagues or even me over the next few hours. But thank you again very much for coming, and with the best will in the world, I hope we don't see you at a similar event until at least the autumn budget, but I wouldn't bet on it.